Presentation Mastery. He's working on level 2 of Presentation Mastery. It is supposed to be working on body language, and the title is Where Do Stock Market Returns Come From? Have you ever wondered why everyone recommends investing in the stock market, or where all those returns come from? Our next speaker has worked at a hedge fund and studied extensively the fundamentals of finance and economics, and he will be telling us more. Please help me welcome Rajiv.
Thank you. Let's see. Just take a moment. Do you have any markers here? Okay. I will improvise. Alright, that's what we're here in Toastmasters for, right? So learn how to improvise, and that's what we're gonna do today. I gotta start off by apologizing for being late. Let me confess something to you guys. The fact that we're a couple blocks away from Wall Street in downtown New York, the capital of capital. I'm giving a speech today about finance and the stock market. This is a dream for me. Thank you all for making this possible. I'm so thrilled to be here. Now, I know not everyone shares my passion for finance. In fact, a lot of my friends seem to think that finance is a bunch of BS. That it's just, the stock market goes up one day, it goes down the next day. Why does everyone want to invest in it? No one knows. It feels like a bunch of baloney. I don't think so. I think there's a lot of truth to it. Now, but I can see why a lot of people don't believe in the stock market. When you look at what's happening on a day-to-day basis, like it goes down, it goes up, it goes down, it goes up. No one knows why it happens. It seems so random. But when you look at it over the long run, there's actually a lot of fundamentals to it. There's a lot of intrinsic reasons why the stock market generates returns, and why every financial planner tells you to invest some of your retirement savings in stocks, because it does make sense. Now, I think a lot of people understand how other forms of investments work. Like, let's take loans or bonds, for example. You're basically lending money to a person, to a company, or maybe even the US government. And in return, they pay you interest. So imagine if you lend the US government $100, and they pay you back $7 every year for the next 30 years. They're paying you 7% interest. Most people understand why that is good for you, because you're getting back interest-paid money. Your money's not just sitting there, it's actually earning an interest. Now, most people also understand real estate. You buy a home for $1 million, and you rent it out for $70,000 a year. So now your money is not just sitting there. You buy a home, and you're getting rent in return every single year. It makes sense. What about stocks? What happens to the stock market? Now, here's the thing that you gotta understand about the stock market. The fundamentals of why the stock market returns money to you is because of profits. When you buy a share in a company, you're literally owning a very tiny slice of that company. And whatever profits that company makes, that actually belongs to you. Now, a couple of disclaimers that I gotta say up front. We're gonna talk about the very fundamentals of finance today. So if you're someone who actually works in Chase or S&P or anywhere nearby, and you're telling, oh, what about stock splits and dividends and stock spin-offs and what about growth stocks? We're not going to cover all of it today because we only have 7 minutes. We're only going to cover the very fundamentals of finance so that you can understand why the stock market works the way it does. Now, you might be thinking, next time you do a news report about how Apple, Google, Amazon are generating $50 billion, it's such a huge number, and you just own one little share of that company. What does the $50 billion actually mean to someone like you? Now, there's actually a metric that covers this pretty well. It's called the earnings per share. Let's break it down. Let's say you buy one share of, let's say, Apple. You buy a share for $100, and there are 1 billion shares out there. You buy only one share. You now own 1/billionth of the company. Now, let's say Apple made $70 billion or $7 billion in profit over the last year. You own 1/billionth of that $7 billion. $7. The term for this is called earnings per share. You take the total earnings of the company, you divide it by the number of shares that are out there for that company, and that tells you, if you own one share, how much of the profit actually belongs to you. Now, the other question you gotta ask is, how much money did you pay to get that little slice of the profit? So, you own the $7 in profit by buying one share. Let's say you paid $100 to get that share. That means that you gave $100 to Apple, and in return, they're gonna let you own a piece of the $7 of profit every year, over and over again. Sounds similar, right? You loan someone $100, they pay you interest. You buy some real estate, you get back rent every year. You buy shares and you own a tiny slice of the profits. Now, there's two little complications or nuances to the story. When you lend someone money, you're guaranteed a certain interest rate. And when you buy real estate, and that interest rate actually goes in your bank account. When you buy real estate, you literally have someone who's paying you rent in actual dollars every month. In the stock market, you don't actually get the profit, do you? Sometimes you do. When you do, it's called a dividend. That's when the company decides, oh, hey, we made all these profits, we're going to give it back to the shareholders, and they call it a dividend. But not always. Other times they use the money to do what's called a share buyback or a stock repurchase. They also buy other companies, or sometimes they just reinvest the money in the business, but that's all very more advanced stuff. The basic point is they're doing it because it's in your best interest. You're getting the benefit of those $7, even if they don't immediately give it to you. You're getting the benefit in other ways down the road. So the other nuance I should mention here is that the profits that you're getting could change. When you loan the U.S. government money and they tell you we're going to pay you 7% interest every year, they're going to pay you 7% interest every year. You're getting the $7 guaranteed. When you buy real estate and you rent someone for $7,000 a year, you're getting that $7,000 a year guaranteed. In stock market, when you buy stocks, the profits could change. Sometimes a company does well, they make more profits in the future. Sometimes a company does badly, they make less profits in the future. If you look at any single company, the amount of profits they make goes up and down all the time. But if you buy the entire stock market, if you combine all of them together, using something like the S&P 500, for example, that way you get to average it all out, and it's much more stable. It turns out that if you look at the S&P 500 historically, if you take the earnings per share and the number of and you divide that by the amount they paid for the share, that's what they call the earnings yield. You get something that's in the 5 to 10% range. That's one of the big reasons why you make money in the stock market, because for every $100 that you invest in the stock market, they're generating profits that belongs to you of about $5 to $10 every year. Now, this would be true if the profits were consistent year after year, but it's not only not consistent, it's not only going up and down, it's actually grows on average. If you look at corporate profits 50 years ago compared to how much profits corporations are making now, they're making a lot more profits now because the economy has grown a lot. Now, what's a pretty good way to measure how well the economy is growing? The GDP. It's not a perfect correlation, but in the long term, when GDP grows, corporate profits go, which means that your piece of the profits are also going to grow. This is why a lot of economists, investors, and everyone are very happy when they see the GDP growth rate increasing, because that means the profits are going to go up, which means that you are going to make more returns. Combine those things together. You're making a tiny piece of the profits every time the company makes profits, and as the company grows, as a result of the GDP, your investments are also going to grow with it. There are lots of things out there that don't make sense. I don't like gold, I don't like Bitcoin, because they generate no profits whatsoever. It's worth whatever people think it is worth. There's no way to really predict what's going to happen. But when it comes to loans, real estate, and especially stocks, there's risk. It can go up, it can go down, but there's a reason for it. And over the long run, it will make you money. Thank you.